Welcome to GRE. I'm your host, Keith Weinhold. Learn just how far behind today's 30-year-olds are, then American history by decade as the nation approaches its 250th birthday. Finally, a conversation about what's next for the housing market with Redfin's Chief Economist Daryl Fairweather today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to Get Rich Education. I'm your host, Keith Weinhold, the voice of real estate investing since 2014. Almost nobody talks about a really important story going on in America today, and I find this really astonishing. I mean, you could almost never think of America the same way again, as you'll hear. While you've got these other headlines out there constantly sucking oxygen out of the room, like decisions from the White House and inflation and wars, one big story, it moves so slowly that it kind of creeps up on you. It is the jaw-dropping change in American society over the last 40 years, and then we'll discuss its seismic changes for real estate. And this is sourced from a Census Bureau supplement. It's about how fewer U.S. adults reach typical life milestones by age 30. And this is partly because more adults opt for college than in previous generations. Oh, well, college doesn't sound like such a bad thing. I'll get to that. And by the way, 30 is an age that has come and gone for me, so I've lived through it. We're looking at a period from 1985 to 2025, so 40 years. First, it's those that live on their own. In 1985, it was 83%. Today, it's just 67%. So then the percentage that don't live on their own and probably live with their parents or roommates, that has doubled. You see even more drastic declines for other milestones since 1985. Those that have ever married from 77% down to 45%. Those that live with a child and the responsibility that this entails, that's fallen from 59% down to 36%. And those that own a home, 48% down to 29%. And again, this is for all 30-year-olds since 1985. This steady, sliding, relentless decline of those who live on their own, are married, have a child, or own a home is pretty stunning. And this is inside the most powerful nation on earth. And here's the thing, this pattern from about 40 years ago, it unabatedly crosses through booms and busts and bubbles and bailouts, sort of like it didn't even notice those things. Somewhat ironically, what's grown during this time is the percentage that have a bachelor's degree. It's gone from 25 up to 43%. So therefore, here we are. We've got this generation that's better educated than ever, and yet more of them are stuck down on the launch pad. It's like we built better rockets, yet we can't light the fuse. And before I help you make sense of this and tell you what I believe the main force behind it to be, you just got to consider what an unfathomable aberration this has all become. At age 25, James Madison was the key architect of the U.S. Constitution. A lot of Constitution signers were in their 20s and 30s. At age 21, Steve Jobs started Apple in a garage. At 20, Bill Gates co-founded Microsoft. At 19, Mark Zuckerberg built Facebook in a dorm room. And sure, some of these are exceptional examples, but these people committed early, and then they figured it out on the fly. Well, what about women? The U.S. birth rate has hit an all-time record low because today, nearly half of 30-year-old women are still child-free. Okay, so some of this is logical. You can connect a few dots here. More time in school. Yeah, all right, that means later marriages and later kids. Sure. Student debt. That equals financial gravity boots that keep you in place. Urban living means smaller spaces. But when you stack all this together, like I just laid out, later, it's not just later anymore, it is really later. That is the huge change that really startles you when you put all of this together. And again, remember, over this same time span, 1985 to today, I've mentioned before how the average age of the first-time homebuyer has ballooned from 29 up to 40. I mean, 40, that can really take some time to sink in. And again, that's just the average. In high-cost housing areas, this number could be 45 or higher. I mean, sheesh, the starter home is now like a midlife purchase, and it's made right around the time that your back starts to make decisions for you. Consider where we are here. Now, the term homeownership, that is increasingly linked to older people. Those things, homeownership and older people, are increasingly synonymous terms now. Owning a home, it's like a luxury good for the already established. I mean, it is pretty jaw-dropping. And one contributor to these trends is the lack of available housing supply, still a 60 to 70% collapse in some populous Northeast states. But really, something like that, that's just a small thing. When you amalgamate it all together, it's become cultural. Really, the bigger trend that underlies this decline in meeting life milestones at age 30 is that long-term true inflation exceeds wage increases over the decades. But there are big social shifts too. And by the way, I left my parents' home for good at age 23, and some surely do so younger than I did. Marriage and children, they are the classic triggers to buy a house. And the longer that these type of milestones get postponed, the more likely people are to favor then flexibility over committing to a mortgage. And this then means that there is an elongated renter stage of life. Renters are no longer just passing through. They're no longer just graduating from college, renting a year or two, and then buying a home. Instead, they are planting flags and really pounding in stakes. And there are countless surveys that show that renters value the ability of being able to relocate without the hassle of having to sell a house. And on top of all of these trends, as America ages overall, something really interesting starts to happen. This is why single-family rentals have really begun to shine over the past few years, and why you had this advent and popularity of new build and build-to-rent rental properties coming onto the market, because single families give people the feeling of home and space and privacy and a backyard for the dog, but yet at the same time, it's commitment light, a lighter version. Now, apartments benefit too, of course, and For investors, this isn't just a trend, this is a long-term tailwind. Fewer life transitions. It means more stable occupancy and longer renter life cycles that lead to fewer turnovers and vacancies and repairs. So less churn, more consistency, and better predictability. So the bottom line here is that this delay of life milestones, it's not subtle, it is pretty seismic. And increasingly, people say that the American dream no longer even includes homeownership. Demography is destiny, and they must rent from you. And here at GRE, we invest like these trends are real. But I really want to emphasize that this elongated renter stage of life really is a long-term, long-tail phenomenon. And I want to emphasize that because, like I said last week, in the short term, we really aren't seeing any significant rent increases due to that affordability constraint. Now we're nearly 5 years after America had a big wave of consumer inflation, and that really hurt kind of people this age that I'm talking about, people in their 20s and 30s. That really hurt them the most because they don't own assets that compound with the concurrent asset price inflation. They only had to deal with the bad stuff, the consumer price inflation. And as America approaches its 250th birthday, let's think about how this era compares to other decades. And by the way, do you know what a 250th anniversary is called? I put a line about this in my newsletter that I sent you the other day. It is called a semi-quincentennial, or I guess semi-quincentennial. I don't think that anyone's going to be using that word after the fireworks. Semi-quincentennial. That sounds like a word that an economic committee came up with during a recession to kind of mask a worse problem or something. I suppose that the etymology makes sense if you break it down. Quincentennial would be 500, and semi would be half of 500. In any case, as you try to compare this American era to others, listen to this from The Parallel Truth. This is about 3 minutes long, and then I'll come back to comment. It's America by decade, starting all the way back in the 1770s. This is a decent summary here, although it can get unnecessarily gloomy at times.
Imagine you could live in the United States, 1 decade at a time. Not the America you see in movies, not the America in textbooks, but the real America. Let's start with the 1770s, the decade of independence. This is not a freedom story yet. It's a war story. Most people are farmers. Roads are mud. Medicine is almost nothing. And if you're a young man, your future is simple. Fight or starve. Then came the 1800s, the decade of expansion. America is still small, but it's hungry. New land, new states, new promises. But there is also growing slavery. Native tribes are being pushed out, and the country is quietly building a conflict it can't avoid. Now it's the 1860s, the decade America almost died. There is civil war, brother versus brother. Cities are burning. If you lived here, you didn't watch history. You survived it. Next is the 1900s, the decade of industrial America. Factories, railroads, steel, oil, the country becomes a machine. Cities explode with workers. But life is brutal. Long hours, dirty air, child labour. You might earn money, but you will pay with your health. It's the 1920s now, the decade of jazz and madness. This is America's first big party decade. Cars, radio, Hollywood. Everyone thinks the future is unstoppable. Then came the 1930s, the decade the party ended. The Great Depression happens. Banks collapse and jobs disappear. People line up for bread. A man with a suit could be broke in 1 week. This decade teaches America one lesson, that money is not real until it's in your hand. It's the 1940s now, the decade America became the world's boss. World War II turns the US into the world's factory. While Europe is burning, America is building. And when the war ends, America comes out richer than anyone in history. It's the 1950s, the decade of the American dream. Suburbs, big houses, one salary supports a whole family. TV dinners, new cars, new highways. This is the decade America sells the world the idea of perfect life. Next came 1960s, the decade of rebellion. Civil rights, Vietnam, assassinations. The country feels like it's splitting. You could be hopeful or terrified, sometimes both in the same week. 1970s was the decade the system started breaking. Oil crisis, inflation, crime crime rate. And in 1971, America quietly changes money forever. The dollar stops being backed by gold. From this point onward, America runs on trust. It's the 1980s, the decade of Wall Street America. Big business, big spending, the stock market becomes religion. America looks confident again, but the middle class starts weakening slowly. Then came the 1990s, the decade America felt unstoppable. The Soviet Union has collapsed, and the US feels untouchable. The internet is born. This is the decade where Americans truly believe that they have won. It's the 2000s now, the decade of shock. 9/11, wars, fear, surveillance. Then 2008 hits, banks crash, housing collapses, and America learns something painful. The people who caused the crisis don't pay for it. It's the 2010s, the decade of the digital trap. Social media becomes reality. Politics becomes war. Everyone is online, but nobody feels connected. The economy recovers, but normal people don't. And finally, it's the 2020s. The decade chaos became normal. Pandemic changes everything. Supply chains are collapsing. Inflation returns. AI arrives, and trust collapses. And by 2026, America is still rich, but it feels exhausted. People are working harder, owning less, and trusting nobody. And the strangest part is that America didn't collapse. It just slowly became a different country. Not through invasion, not through revolution, but through decades of small changes. That added up to a completely new reality. So the real question is, if you could choose one decade to live in, which one would you pick?
Yeah, which decade would you pick to live in? A lot of people say the 1950s, where we had, like they touched on there, the post-war boom and how one salary could support an entire household. Some people say the 1990s, because the Cold War ended, we had the start of wide internet use, and it's before you had these stark political divisions where people started to put party ahead of country. Now, some people would probably say, are you kidding me? I'd rather live in this decade right here. I can work from home more easily than I ever could have before. And I think you can make valid cases for all of those things. And speaking of this era, a quarter just ended, and we do this quarterly at most. It's our asset class rundown. Year over year, national home prices are only up about 0.5% per the NAR, 1% Case-Shiller, and Cotality's single-family rent index shows just 1.3% rent growth. That's year over year. This quarter, the S&P 500 was down 5%. Stocks of all types are down, largely to the Iran war. The yield on the 10-year Treasury note rose from 4.1 up to 4.3% due to higher inflation expectations. Why does that matter so much? That's what influences 30-year mortgage rates, which also rose from 6.2 up to 6.5%. West Texas Intermediate oil prices soared from $59 to over $100 last quarter. Gold hit an all-time high of $5,400 in the quarter and then fell to about $4,600 by the end of the quarter. Other precious metals hit their all-time peak. Bitcoin fell from $88K down to $68K. That's the asset class rundown. I'll return with Redfin's Chief Economist Dr. Daryl Fairweather and more. I'm Keith Weinhold. You're listening to Get Rich Education. Let me throw out a simple idea. Sometimes doing nothing with your money is actually a decision. Leaving it parked might feel safe, but over time, purchasing power changes. So the conversation isn't about chasing returns, it's about intentionally placing money somewhere. Freedom Family Investments works in real estate people use every day: housing, senior communities, essential properties, things tied to living and not trends. Their Freedom Notes offering is built for accredited investors looking for structured income backed by real assets, not speculation. I am an investor with them myself. The Freedom team makes themselves available to walk through their approach, structure, and operating philosophy so you can ask questions and determine alignment before moving forward. While past performance doesn't guarantee future results, their historical operating philosophy has yielded 100% investor payouts backed by over 20 years of experience. If you want clarity before making any moves, book a clarity call at freedomfamilyinvestments.com or text family to 66866. Text the word family to 66866. Flock Homes helps you retire from real estate and landlording, whether it's one problem property or your whole portfolio through a 721 exchange, deferring your capital gains tax and depreciation recapture. It's a strategy long used by the ultra-wealthy. Now, mom and pop landlords can 721 their residential real estate. Request your initial valuation. See if your properties qualify at flockhomes.com/GRE. That's FLOCKhomes.com/GRE.
Hey everybody, it's Robert Helms of the Real Estate Guys radio program. So glad you found Keith Weinhold and Get Rich Education. Don't quit your daydream.
This week's guest is the chief economist of Redfin. During the housing crisis, she worked at the Boston Fed studying why homeowners entered foreclosure. Since 2023, she served at the Federal Reserve Bank of Dallas. She holds her BS from MIT, and she really knows her way around campuses because she received her master's and PhD in economics at the University of Chicago, where she specialized in behavioral economics. That's interesting. Welcome to GRE, Daryl Fairweather.
Thank you for having me.
Hey, Daryl, I'd like to get to some of the statistics later and the things that Redfin does and compiles, but tell us about the behavioral side of the housing market that's often so interesting and even counterintuitive.
Yeah, one of the most interesting things about the housing market is that people get really emotional when making this huge financial decision. It's something that people don't have a lot of practice with. Most people maybe buy a home once or twice in their whole life. There's so much social weight that's put on it. It's the American dream. There's a lot of family pressure. And there's a lot of hurting behavior that can happen. People get swept up in the moment. Maybe they overbid on a home, or maybe they miss out because other people are avoiding the housing market. So it's a really interesting place to both study psychology and economics.
Sure, most homeowners are just inexperienced at this whole thing. Yeah, behavioral economics, it really has this strong gravity in real estate. Maybe something that you said touches on what I call the Zestimate illusion. A lot of times sellers anchor their price to not just the Zillow estimate, but sometimes even the peak sale price in the whole neighborhood. And that's what they think that they should get for their home.
Yeah, that does happen quite a bit. And I don't think a lot of people realize how much those estimates can move. Once a home is listed, the list price tends to move that estimate quite a lot. So it's not a fact. And those estimates don't really know many details about the home, like what upgrades might have happened or what internally is happening within the home. Like if people have gotten new appliances or gotten a new air conditioning system, it doesn't really take those things into account. So you shouldn't just anchor off of the Redfin estimate. You should definitely talk to an agent. Look at the comps. The comps can tell you a lot in terms of what homes have sold for recently. And then track your local market in terms of whether it is going up in value or down in value, because those comps might be a little bit stale and you have to adjust for where the market is right now.
There's some really good points there. And when I think of the behavioral side of economics in the real estate market, another nascent thing that comes to mind, Daryl, is the rate shock paralysis that really set in America in 2022. Mortgage rates are still historically on the low side, but few people think about it that way. They're really swayed by the recency bias.
Yes, and one thing to take into account, though, is how much home prices have gone up since the last time rates were this high.
Right.
So if you're looking at the monthly mortgage payment and how much that is compared to people's monthly incomes, it is quite expensive to buy a home. In most metros, you cannot afford to buy a home on the local median income. There's only maybe 4 metros that are in the middle of the country where it's still affordable to buy a home on a middle class salary. So combined, the rate and the price, those mortgage payments are still quite expensive, although they have gotten slightly more affordable since last year because rates are slightly lower than last year. They did come up a bit with, oil prices coming up, but still compared to last year, rates are a bit lower and a bit more affordable to get a home.
And of course, all this is besides the point that those 2021 mortgage rates, they were born out of a collapsing economy. And I don't think that we really want that either. But yes, to your point about affordability, that's been such a buzzword in the housing market for quite a while, and for good reason. It wasn't very long ago that we reached a 40-year low in affordability. Can you tell us about what can improve affordability next, Daryl, or what's most likely to happen? For example, it seems like insurance rate increases have really leveled off.
Yes, the reason why affordability is so bad, especially in coastal cities, the places that have the most opportunities, is because of a lack of supply. Existing homeowners, they are fine. They like when their home goes up in value, but it really is a problem for first-time home buyers when prices just keep climbing. And when new housing gets proposed, it's often the existing homeowners who are blocking that housing from getting built. And so supply is constrained. You can see this very clearly in a place like San Francisco, which had a huge economic boom in the 2010s, yet housing did not keep up with all of the job opportunities that were coming to the area. And when you have all these people moving in with higher incomes, it drives up prices when there isn't adequate supply. You take Austin as another example. Austin had a huge boom during the pandemic, but supply responded. Builders built. There was a lot of development that happened. And as a result, prices came right back down. They're still above where they were pre-pandemic, but nowhere near the heights that we saw back in 2021. So it just goes to show that when you allow supply to get built, it does help keep prices more moderate and keep things more affordable.
Yes, and NIMBYism is as rampant as consumer inflation or some of the other big forces out there for sure. But yes, this national dearth of supply, something that's existed even well before the pandemic, for example, it's bounced back somewhat, but still not quite enough. And it's really part of what, in my opinion, has helped support housing prices, even when mortgage rates tripled back in 2022. Can you tell us more what you believe about the future of housing supply with all the data that you deal with there at Redfin, Daryl?
Housing supply improved a bit during the pandemic, but we're still far below what we need in order to make housing more accessible to middle class people. But there are new challenges that are coming. One that you mentioned is insurance. Insurance costs are going up. So even if you have a fixed rate mortgage and you've locked that in, you still have to worry about the rising cost of ownership because of insurance costs are going up, property taxes are going up in many places, and maintenance costs are increasing. So that is going to make home ownership and just the cost of ownership in general, whether you're an investor or an owner occupant, more expensive moving forward. And that's going to vary depending on where you are. There are going to be some parts of the country where insurance goes up much faster, like in Florida, and other parts where insurance will probably be more stable, like in the Midwest and Great Lakes region. So it's important now, even more so, to really research the neighborhood, research the home, and figure out how those expenses could increase in the future.
Yeah, here we are in this housing market where, Daryl, I think of it in a lot of ways as, maybe for 3 years now, we've largely been stuck in the mud, much of it due to lower supply, where we have a lower overall proportion of both buyers and sellers.
Yeah, what's happening right now is really an hangover from the pandemic because so many people locked in 3% mortgage rates during the pandemic. And if those homeowners were to sell and buy again, even if they bought the same priced home, they would end up paying more in their monthly mortgage payment because of how much higher mortgage rates are. And that's holding back supply quite significantly. It's the reason why prices have not come down despite rates going up, is because the higher rates are holding back both demand and supply at the same time and contributing to the overall lack of inventory that's out there.
This aberration where we have a big proportion of American homeowners living in homes where if they tried to repurchase that home at today's terms, they couldn't even do it, to your point about people not wanting to move. And that's a big reason why they almost can't. They might pay more in rent elsewhere for a like property if they were to sell what they own at those still locked in terms. And Daryl, here, I think our audience is largely real estate investors, a lot of them investing in 1 to 4 unit properties. So with what you're seeing there at Redfin, I think a lot of us know that, rent growth has been pretty slow as well. What do you see for rents in 2026 and perhaps 2027?
Originally, when we went to go do our predictions for 2026, we said that rents were going to increase this year. Now I think that rents will continue to stay flat. And that's because there's still a lack of demand for sale housing. People are staying in the rental market, but people are overall tightening their budgets because they're worried about the economy. They're worried about inflation. So if they can, get roommates or live with family, they're going to choose to do that to keep their overall expenses lower. which will reduce demand for both for sale housing and for rental housing. And I think a lot of home sellers, they've tried to sell their homes. We saw many people try to sell their homes last year and then end up delisting their homes. And they're trying again. We saw more of those people come back in January. But I think those people are going to continue to kind of try to test the market, be a bit disappointed that there isn't enough demand. And then some of that for sale housing will end up as rental housing. Just driving around my neighborhood, I see so many rental signs on single family homes that I never saw before, almost more for rent signs than I'm seeing for sale signs. So that added inventory from these accidental landlords who would like to move but don't want to give up their mortgage rate is going to increase the supply of single family rentals. And that will mean more competition for those investors that are trying to rent out their homes.
Now, talk to us about rental occupancy. That's something that we're seeing at a historic low in apartment buildings, for one thing. But can you talk to us about what you see for future occupancy levels of both residential 1 to 4s and apartments going forward?
A lot of new supply came online during the pandemic, especially in places that build a lot of condos. Many 1-bedroom or 0-bedroom condos got built, and then those were really difficult to rent out because, they're just not that attractive. We really have more of a shortage of types of housing that's appropriate for families. And those 1-bedroom units that are really targeted at like affluent young people, there aren't that many affluent young people right now. So they're difficult to rent out. I think that trend is pretty much over. We're not seeing too many more condos being developed because the condos that were developed during the pandemic are still having trouble finding owners or finding renters in those apartment buildings. Now I think we're going to start to see an uptick in single family rental vacancy, because I think a lot of those people who would like to sell their homes are having trouble selling their homes because of how high mortgage rates are and how skittish people are about making a commitment to ownership right now. And they're going to alternatively try to rent out those. And that will mean more availability of those rentals and not as much pressure on rents to go up in that segment of the market.
Woe for the builder that targeted young, affluent types. They don't really exist so much anymore. That's really pretty interesting. Well, Daryl, do you have any last thoughts overall about the housing market? Maybe something I didn't think about asking you that's really important, whether that's for an investor or a prospective homeowner?
Yeah, I think if I was an investor right now, I would be paying attention to what economists and housing people call the silver tsunami. That's older generations starting to sell their homes. We did a study recently that showed that people who are 70 years and above have as much wealth in housing as middle-aged people, which is the first time that group has exceeded in terms of the wealth that they hold. And if you're 70 plus, there's definitely a clock ticking on how long you're going to stay in that home, which means that a lot of new inventory will become available. And those homes, they probably need work. They probably need some renovations. And that could be a really great opportunity for an investor to buy a home that maybe has been neglected for a while because it's been a senior living in there who hasn't been really keeping it up to date. You can renovate it and perhaps sell it again to a younger buyer by doing some updates and make a nice profit there.
Oh, well, Daryl, this has been a great update laced with plenty of practical things that someone can actually do. Do you have a resource you'd like to share in case our audience would like to connect?
Yes, you can find me basically on any social media channel. I'd recommend checking me out on YouTube to start. And then if you would like data on what's happening in your local housing market, you can check out the Redfin Data Center. Just Google Redfin Data Center. It'll bring you right there, and you can find lots of local data on your market.
Daryl Fairweather, it's been great having you here on the show.
Thank you.
Yeah, insightful material from Dr. Daryl Fairweather today. No end to the housing scarcity in sight. She says rents continue to stay flat, partly due to this accidental landlord. They didn't plan to be a landlord, but they need to move, and yet they don't want to sell the single-family home that they got with the good owner-occupied financing a few years ago. And the reason that's a headwind for single-family investors is because it keeps more rental supply on the market. Last week, I touched on how you should not expect rent increases in the near term. I own a lot of single-family rentals myself, and I am not getting rent increases. It's not so much that single-family vacancies are high now, but apartment building vacancies are high. That fact alone that actually does hurt the single-family rental market a little, because even though a renter might desire a single family, and maybe you think, well, an apartment couldn't compete with that feeling, but yet if an apartment is so much cheaper than the single family, and they often are now, well, then that renter will go for the cheap apartment instead. The way you can think of Redfin is that they're part Zillow, part real estate agent, and part data company, and they can give you early signals on things like buyer demand and price direction and days on market, those types of indicators. So for the latest housing market research and news, you can do a search for the Redfin Data Center. And then for Daryl, start on YouTube. You can follow her on X at Fairweather PhD. Thanks to Dr. Daryl Fairweather today. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.